fraud investigations I've done over the years, fraud training, cybersecurity training, cybersecurity audits, cloud security audits. Now the future of technology is cloud. So we have to also start veering off into the cloud so that we can learn more about the cloud. And then IT audits, and now also facilitate tuition for some of the SEMA case studies, specifically operational management and strategic, and also teach CIA, Certified Internal Audits, and Certified Fraud Examiner, as well as CISA. Aside that, I do a lot of consultation across board. So this is a bit of me whilst we proceed. Now let us understand the context. It is very broad, but we need to narrow it to understand the context so that we can be able to benefit from it. And in the context, we need to start with what is revenue. What is revenue? You'll be hearing revenue, revenue, revenue. We want to detect fictitious revenue. What is revenue? If you don't understand what is revenue, what are you going to do to detect revenue? You cannot, if you don't understand something, how can you review or even audit or even detect what you don't even understand? So in the context of revenue, it's basically income that a business earns, either by selling goods or services to a customer. So if you sell goods or services to someone, and automatic control of that good or service, then you tend to recognize it as revenue. You tend to recognize it as revenue. This may include sales of goods or services, interest that you have received, dividends that you have received, rental income. All of it is classified as revenue streams onto your income statements. And within this, we have other names that we use for revenue: sales, revenue, and sales. So if you hear revenue, if you hear sales, if you hear revenue, they are all within the same alternating around. So revenue is basically, you do business, either you sell a good or a service, but when the customer is in control of that good or service, then you tend to earn revenue. You tend to earn revenue. So that is what you have to understand as revenue. What is financial revenue? But if you don't understand what financial statement, the components of financial statement, then where are you going? So basically, financial statement is just a summary, and some very summary, high-level report that will show financial results and also the position and cash flow of a business. So if you pick the high-level report, you are going to see components of the financial statement, which you see income statement, which you see balance sheet, which you see cash flow, statement of cash flows, and you are going to see statement of changes in equity. So these are the 5 main components that you can glean from a financial statement. So you need to understand what is a revenue. You need to understand what is a financial statement and what are the components that we classify as part of the financial statement. Yes, you've heard of the balance sheet as part of the components. What is the balance sheet? What is just the balance sheet? Basically, it just shows the assets and liabilities, the equity of the organization. That is the position, financial position of the organization at a particular point in time. What is an asset? An asset that you own, that you can use to generate revenue into the business in the future. Liabilities is something that you owe to other people, that you intend to pay off. It could be long-term loan that you've taken. It's a liability. And equity represents the value or equity or shareholding or your investment that you have invested into the company. That becomes the equity. So if you pick the balance sheet, you need to understand where to get the assets, where to get the liabilities, and where to get your equity. So that is that for the balance sheets. Then we move on to income statement. Income statement. When you pick the income statement, what do you see? You have to see revenues. You have to see expenses, and you have to see profit. So basically, revenues is what you sell to generate over a period of time. And normally it's through your normal operation that you do. So if you are selling mangoes, you make your money. It's either in cash or in credit, depending on how you recognize it. But we are going to go get there when we get to the IFRS 15 to explain how revenue is actually recognized within a financial statement so that you can be able to detect it when you see that something wrong is happening. Expenses is what you incur in running the business. So you pay salaries to workers to do the work for you. It's an expense. And at the end, you take your expenses from your revenue, then you have to get what you call your net income that you can use to run the business. This is on a basic level within the income statement. And I want you to understand the component of the income statement because our main focus is on detecting fictitious revenue. And the revenue that you see will be within the income statement. So you pick the income statement. How do you determine that something fictitious is happening? Then we look at the financial. Another component is the cash flow. The cash flows that you use within the business, which could be in the terms of operating activities, which could also be in the form of investing activities and financing activities. So your operating activities, the revenue and operating expenses. Then the investment is probably you sell certain assets, you purchase certain assets into the business. Then when you are financing, you issue shares or raising of debt to support in the form of cash or whatever form you want to go. Then you get your cash flow statement. So that is what you have to also understand within the financial statement. Then we go on to the changes in equity. This is the equity you have in the business. This is the equity you have in the business. And normally, you need to specify the equity that has come, the equity that has gone, and all the impact that is having within the business. So a lot of components go into the equity position. Then, after understanding revenue, understanding the financial statement, and knowing that I need to concentrate on the income statement to be able to detect a fictitious revenue, then we move on to what is a financial statement fraud. You now know the financial statement, but what is a financial statement fraud? That is what we have to understand. This is where companies deliberately misrepresent the financial condition of the business. It is just an intentional misstatement or omission of some amounts or disclosures in the financial statement. The ultimate idea is to deceive all users of financial statements. So when we say users, it will be anybody at all. The government is a user, employees are a user, the manager is a user, everybody who has a stake in the business is a user of the financial statement. The shareholders are users of the financial statement. So financial statement fraud, it is a deliberate misrepresentation. Companies deliberately misrepresent the actual state of the organization. And that is where we have a problem. In the past, we have seen banks that were collapsed because the assets they presented to Bank of Ghana never existed. Never existed. The cash position they represented to Ghana never existed. In the form of equity, it never existed. And those banks were collapsed. Recently, if you are following US, if you are following the US financial crisis that is going on, the Silicon Valley Bank, the Credit Suisse Bank, and other banks, Signature Bank, and all those banks, what is happening? If you read detail into it, there are a lot of lessons that I think in the future you'll get time to learn those lessons. But all boils down to the risk management, which then falls into the operational risk of misrepresenting information on the financial statement, misleading the public on the financial position of the. Look at Silicon Valley Bank. In UK, the arm of Silicon Valley Bank in UK was bought by £1. A bank that is valued over 200 billion pounds was bought by £1. Why? Because of certain things that happen within the space, which you need to be aware of. And so, in understanding the financial statement fraud, what triggers these things within the statement, what will move the management, the executive, the board to misrepresent the financial statement? There are certain red flags that you have to, that contributes to the financial statement fraud that we have within the system. And we use the fraud triangle propagated by Dr. Chrissy, who was a criminologist. Most of we, the fraud examiners, we base most on our fraud things based on his writes and articles that he did over the past, and it's still helping us. So using the fraud triangle, we need to understand some of the red flags that pushes management and executive to misrepresent data on the financial statement. One, we can take it from situational pressure. Situational pressure. So when management realizes that revenues, we've already understood what revenue is. Revenues is decreasing at a faster rate. There's pressure on them to report fictitious revenue to just appease the shareholders and the stakeholders and to make a position within the public that they are doing well. So immediately they see that there's decrease in revenues, then they start trying to find a ways and means of getting the revenues back and by falsely misreporting it. Then normally unrealistic budget pressure. The board will come and say, produce 10 million profit for us. It's pressure on you. So because of that pressure, people are pushed to misreport the actual revenues on the financial statement. Then also when management and executive have been promised a big bonus, at the end of the year, we are going to pay you this much bonus. So give us 10 million profits. Because of the bonus, they are going to misreport the actual revenue to be able to get that bonus. So this, under the situational pressure, could push management to misrepresent information on their financial statements. Then we can look at the opportunities that could also come. We've looked at the pressure. Now, what is the some of the opportunities that could create that kind of fictitious revenue on the financial statement? Sometimes you go to some companies, board of directors are not there. They don't have an audit committee. They don't have board of directors. Even if they have board of directors, it is family and friends board of directors. There is no an objective person to put them on their toes. Sometimes the board of directors may be there, but because they are friends and family, they cannot say anything. Sometimes internal controls do not exist. You see management overriding controls. The board says beyond 10 million, bring it to me for approval. You realize that beyond 10 million, 50 million, management is approving because they are overriding the controls, because the board themselves are not overseeing the management of the organization well. And sometimes you see a lot of complex transactions happening, a lot of transfers going up and down, so complex, unusual. All these are red flags. You see them within the financial statement. All of these are red flags. And normally, sometimes when, as a chartered accountant, I've prepared accounts before and I'm still preparing, you realize that when it gets to the adjustment stage and we are preparing the account, you realize that we'll be making subjective judgments. We'll be adjusting the figures based on our own subjectivities. In doing that, it gives room for revenue to be fictitiously misreported on the financial statement. So when all these opportunities are there, they are all red flags to tell you that the financial statement that has been published is not what it says. Then we move on to the last leg of what Dr. Chrissy said, rationalization of the fraud. So management will say, oh, let us inflate revenue this year. The following year, we can deflate the revenue to tell them that we didn't do it that year. That is, they are rationalizing what they are doing. And sometimes they'll say, oh, we want to alter the financials to just appease the investors. They will not know. The shareholders will not know. Some of the shareholders, they are there. When they go for meetings, they don't even understand the financial statement to even ask questions. Hey, this is what we got. They accept and they move on. As to whether the figures have been changed or not, that one they can't tell. They can't question. they are not skeptical about things, because we have seen the US banks that are going down, that they've started blaming the external auditors, KPMG and Deloitte, and all the external auditors that pass those financial statements, that now they have collapsed. They are questioning the work they did. And normally that is what happens. So the external auditors go and then they pay them and they sign the financial accounts. So as to whether it is doing well or not. So far they've gotten what they have to get, then they'll sign. And then the following day, you see the bank collapsing. And sometimes they also rationalize by saying, let us understate revenue this year so that we can also take advantage of a lower tax. So when they understate revenue, then definitely you can't tax me more. So these are some of the rationalization that is normally done. And when you see all these things happening within the financial space, then you should have questions to ask, because they are all red flags that will contribute to the fictitious revenue that we are speaking of. Moving on, before you to understand how to detect revenue, we need to understand IFRS 15, International Financial Reporting Standard 15, which we have subscribed to. And in subscribing to it, to understand what the standard states. If you don't understand what the standard says, and you are auditing or reviewing the income statement, how would you know that revenue has been recognized in accordance with the standard? So let us go to IFRS 15 and then understand. IFRS 15 says that revenue recognition is normally specific conditions in which revenue is recognized and how it is accounted for. The principle behind this is we are using accrual accounting. Revenues are recognized when realized and earned, but not when cash is received. Please understand this recognition criteria. Understand this principle. The fact that a transaction has taken on, you have not received the cash. The customer is in control of that good or service you sold to. Then you have to recognize revenue, but not necessarily when you have received the cash. So you could receive cash and it could also be on credit basis. So the principle behind IFRS 15 says that what? When you deal in goods and services and someone buys those goods and services and doesn't pay cash, but the person you sold the goods to, that is a customer, the customer then controls or receives those goods, then you have to recognize revenue in your financial statement, but not when cash is paid, because cash can be paid in the future. That is why we have account receivables. You give it to them on credit and you have to collect it in the future. So revenue is recognized when goods and services are exchanged and the customer is in control of it and you recognize it, not necessarily receiving cash. That is the principle behind IFRS 15. And these are the guidelines, 5 guidelines that the standard has given to us. 1, identify the contract. What is a contract? I'm selling goods and service. What is the performance obligations? I am promising to sell it to you at this price. Then, after allocating the price to the performance obligations, then recognize revenue when the performance obligations are satisfied. So I've promised to give you these goods. I have given it to you. You have received it. Then I have to recognize revenue, but not necessarily I have received the cash. That is the entire understanding of IFRS 15 in its simplest and basic format. So you need to understand before you can detect and be able to review and detect revenue, fictitious revenue in the financial statement. So if you don't understand IFRS 15, I will encourage you to go and read further to understand. But this is the basic principle. Then summary of revenue recognition principle. Revenue is recognized in the period in which it is earned. So if you sold the thing today and the customer got it today, you have to recognize the revenue today. That is the period in which you earned that revenue, but not when you have earned a thing today and you are going to recognize it in the next year or next 2 years. No, that is not what it says. You will not be able to detect any future revenue. So look at it. When was the transaction executed? When was it executed? Which date, which month? Was it recognized within that same month? If not, then there's a problem. Then there's something is going on. And the second principle is that revenues are recognized when it is realized and earned, and not when cash is received. So I want you to take it two ways. Revenue recognition to help you to detect fictitious revenue. One, revenue is recognized when it is earned in the period in which it was earned. And two, when it was earned, not necessarily cash has been received, but the customer has gotten his or her transaction and is in control of that transaction. Then you have to recognize revenue. If you go and you don't see these two conditions, red flag. So that is the recognition principle I need to also understand. Then we move on to our main crux of the issue. How do we detect fictitious revenue? We have understood the context. What is revenue? We have understood the financial statement. We have understood financial statement fraud. What is there? We have understood the components and understood the components as well. And we have also been able to go to IFRS 15 to guide us into the future. Now, how do we detect our fictitious revenue schemes?
Hello.
Hello. Please, are we here? Please, can you hear me?
Yes, I can hear you.
Hear me? Okay, sorry. I just lost network. Please, okay. So now we have understood.
Sorry, sir.
What is fictitious revenue? Hello.
Yes, I want to make an input. Along the line, if you have a question or any other thing, you can kindly leave a question or a comment or in the chat session, so that after we can just, the facilitator will help, we all help to answer some of them. Thank you.
Great. We have understood revenue. What is fictitious revenue? Fictitious revenue, recording of a sale of goods and services that did not occur. So you recorded the sales of goods and services that never occurred, that never existed. That is fictitious revenue. That is fictitious revenue. Now, what is the importance of detecting fictitious revenue schemes? What benefit at all would it bring to the organization? What at all would it benefit the organization? What at all? One, fraud prevention. It helps you to prevent fraud within the organization, because fraudulent financial statements would mislead investors and all stakeholders. So it will help you to what? Prevent fraud from occurring, which in the end, you would have contributed to add value to the organization. If you don't stop it and force financial statements are presented to the public and people gain trust and come and invest in it, and tomorrow it collapses, you are going to be in trouble and your conscience is not going to serve you right. Two, another benefit that our organization stands to benefit is legal compliance. Legal compliance. We are supposed to comply with IFRS 15. So we have the IFRS standards that we have to comply with. And normally when we comply, you are able to be able to detect these fictitious revenue schemes. It helps the organization to comply with the standards or any regulations. If it's a bank, the Bank of Ghana regulations or directives will be there. So it helps the organization to comply with anything. And then also financial performance. Accurate financial reporting is essential for making sound business decisions. So if the financial statements are wrought with fictitious revenues, you can imagine the decisions that will be made based on those fictitious reports, which in the end, it may not augur well. But when you're able to detect it early, it helps the organization to improve upon its performance. And finally, reputation. Reputation. Now in the world, reputation is key. The Silicon Valley Bank issue, just one customer who was a fintech, was to withdraw some monies from his account at Silicon Valley Bank. For some time now, he was not getting, until he blew it through social media, misinformation. And there was a run on this bank. And because of that run, they couldn't survive. No bank will survive. If all customers rush to withdraw their deposits, they will not survive. They will collapse. So reputation is key. So if fake or false or misleading financial statements are presented and people badge on it to invest, it's going to affect the reputation of your organization. And it will be bought at £1, just like what it has happened to Silicon Valley Bank. Even Credit Suisse. You see, UBS Bank has taken over. That is where we have now. So now, the scheme and detection. These are the schemes that you need to understand. These are the schemes that you need to understand and how to detect them. Scheme one, we call it channel stuffing. Channel stuffing. This kind of fictitious revenue scheme happens when goods are shipped to customers before they are needed or requested. So the customers don't need it. They have not requested for it. But because they want to increase their revenue based on bonus that has been promised to them, they will ship the goods. And when they ship the goods, they will record the revenue within the financial statement that revenue has been recognized. You got 10 million for shipping these goods. So I want to ask a question. They have shipped the goods. I'm asking a question. I want an answer. They have shipped the goods. The customer has not received the goods, but they have recognized the revenue in their financial statement. Is it right or is it wrong? If it is right, why? If it is wrong, why? I want one person to answer for me before I proceed.
You can unmute yourself and answer anyone that wants to.
Good evening, sir.
Good evening. Good evening, sir.
Hello.
Good evening, sir.
Yeah, Solomon. Yeah.
Solomon.
Solomon, I just
because Solomon got teacher. So
okay.
Because the car has not.
Please, your line is breaking, so I'm not getting it
so
clear.
Yeah,
Your line is breaking. I'm not getting it
Can
clear.
you hear me, please?
Yes, it's better now.
I'll put in. Is because the customer request for the goods to be shipped, and for that will go and then record into your financial state of recognized revenue is fictitious of that. So that is my answer.
Your line was breaking, so I couldn't really get you the inputs. If Bismarck, you can help me if it's clear from your end.
I didn't get it well myself. So if you can
The line is
reposition
breaking.
it.
Your line is breaking.
Any other person?
Okay, then I will type that.
Correct. You can type that in the session.
Okay, so we can continue. Okay, great. So be aware of channel stuffing, where goods and services are shipped or offered, where customers had not requested for it, where customers don't need it, but because they want to increase their revenue, they create that kind of artificial demand to just show up their revenue, which then becomes fictitious revenue. Please, how do you detect this kind of scheme? Analyze the sales pattern and compare them with the time that the revenue was recognized. So there is a pattern. You have to take sales patterns. You can do what you call trend analysis. You do trend analysis to see the pattern, the trend of the sales. Then you can look at when it was recognized. Then based on that, you should be able to detect whether actually customers actually ordered for these goods or not, or these services were offered to the customers and they agreed and accepted. That is one way you can use to detect what to call channel stuffing. So do analyze the sales patterns, which is key, and compare with the timing of the revenue that was recognized. Then when you do that, you should be able to detect whether it is fraudulent, it is fictitious or not. That is why we initially said the IFRS 15 is going to be our guide. If you don't understand revenue recognition, you cannot detect it. You cannot detect it. So that is channel stuffing. They will ship their goods to the customer. The customer has not requested for it. The customer has also not received it, just to create that kind of artificial demand and then increase their revenue. We have sold 1,000 pieces of laptops, but it was fictitious sales. It never existed. Let's move on to the second scheme. The second scheme is you bill and hold. You bill and hold. You bill and hold. You ship the goods to the customers, but you hold the shipment until the customer requests delivery. So the goods or services have been shipped or have been offered, but you are holding on to it until the customer requests for it. You bill and hold. It has been billed 10,000 Ghana, $10,000. You have billed, you have increased your revenue, but you are holding the good, you are holding that service, you are holding that good that has not yet gotten to the customer. The revenue is recognized at the time of shipment, even though the goods have not been delivered. So I'll bill you and I'll hold the goods, but I've not shipped the goods to the customer. That is bill and hold. It's a scheme that they use to artificially inflate the revenue. And how do you detect this kind of scheme? Again, examine the timing of the revenue and also when it was recognized. and find out the actual delivery of the goods. So we have to do what we call independent confirmation with the customers to see whether actually they have received the goods, because they have been billed. When you check onto the voucher, I say they have been billed, so it has been added to the revenue. That is bill and hold. It's a scheme, and how to detect it, to examine the timing of the revenue recognition, and then also you'll be able to get whether the actual goods were delivered or not. So that is bill and hold. Then we have the third one, which is called channel financing. This one, they do it with banks or financial intermediaries. They do it with banks or financial intermediaries. So the organization will go and see the bank that has stood in for the customer to get the goods, telling the bank that we want you to extend the credit period for the customer. Extend the credit period for the customer. So when they extend the credit period for the customer, then they will then recognize, because they are going to earn interest into it. So they are going to recognize it as revenue that has come. So channel financing. The intermediary, you tell them to extend the credit. Then when they extend it, then you add it to it that these are the necessary receivables that are coming in to us, because we are getting extension of the credit that has been granted to the customer. So this one, how do you detect channel financing? Please, you just have to pick the terms and conditions of the agreement that has been signed and compare it with the revenue figures in the financial statement or your worksheet that will develop to highlight the revenue streams. If you are preparing an account, you need to get the revenue streams where you break down the various channels or methods of revenue that comes in. So if it is interest received, it's a line. If it is something that is coming, it's a line that you have to consider. So you pick the terms and conditions, then you compare the revenue figures. Then you can be able to know that something untoward has happened. That is why their revenue is increasing. Not that it is a real revenue, but because they have connived and colluded with the finance institution to extend the credit period for the customers, thereby hoping that they will get that kind of extra revenue into the stream. Sales returns. This is another scheme that they do. Normally, when you sell to a customer takes it, you recognize it, then the customer will return the good because the good has been malfunctioned. The good has been returned, so sales returns. So when the good has been returned, for instance, then they will recapture it as if it is revenue that has come into the space. That is what they normally do. A commodity or good that a customer returns to a seller for a full refund. So companies can record sales, but later adjust the revenue figures when customers return the products. So always when you want to detect it, you need to monitor the number and timing of returns. So you go and pick the goods that have been returned. You go and pick the inventory, then you can be able to compare them with the figures that have been captured. And then you can be able to detect that this one was a returned good. It's not necessarily that revenue has been incurred, which I have to add it to my revenue stream. So sales returns is also a scheme that organizations use to inflate their revenue for them to deceive people. Then the fifth one is another scheme, early payment of discounts. Companies can offer discounts to customers who pay their bills early, which creates an illusion of increased revenue. So early payment of discounts. So they offer the discounts to their customers. Then they will capture it as if the bills have been paid early to the organization. Then they will capture it that because of the early payment of discounts, it is increasing our revenue. but not knowing it's a discount that you've given to the customer. It is not revenue that is coming in. It is rather going out. But because of that early payment discount, then they capture it as revenue. Then you see, you pick it and you say revenue has increased. Please, they have deceived you. Analyze the terms and conditions of the discount and compare them with the revenue figures. Then you can know whether the items that have been discounted and the payments that have been made, you can be able to detect that no, something wrong is happening within the space. Changes in revenue recognition policies is also another strategy that companies use. Today, they are going to use this policy to recognize revenue. They'll use generally accepted accounting principles from US. Tomorrow, they want to use IFRS. What is this? Tomorrow, no, they want to use revenue recognition from local Ghana, our accounting standards from IC instead of chartered accountant Ghana. Hey, so realize that when revenue policies are changing frequently, please, it's a signal that something wrong is happening. You have to be consistent with the way you recognize revenue. You have to be, if you are using generally accepted accounting principles, which is the gap for US, please use it. If you are using IFRS 15, please use it. If you are using the Ghana one, use it. Be consistent with the policies. But when the policies are changing frequently, every year, policies change. Please, it is a trick. Check. Analyze the company's financial statement and compare the previous periods. So you pick last year, you pick last 2 years, you compare all those periods, and you realize that something untoward is happening. Because last year, revenue increased because they use GAAP. Last 2 years, they use IFRS. So revenue increased astronomically. Last 3 years, they used the Ghana one, and that one, they doubled the revenue. Please pick it and then compare the patterns within it, and then you can be able to tell that something untoward is happening. So this revenue recognition policies is real. If you go to organizations where they are always changing their policies, please, it is a situation that you have to handle as well. Then another scheme is when there are poor internal control within the space. So you realize that one person sits there, does the sale. He is a salesperson. He goes to collect the money. He goes to bank the money. He goes to do everything. One person has been given all the powers and the responsibilities there be. No segregation of duties. Nobody checks on that person. And that person is writing whatever figures he wants to write. Please, when those weaknesses are there, then you should know that it is a scheme that they are using to outwit the system. So please regularly review their internal controls to ensure their effectiveness. So if you go into a space and realize that one person is doing the sales, is doing the recording, is doing the recovery, is doing the banking, everything, please advise them to do what we call segregation of duties. SOD. Segregation of duties. One person shouldn't do everything. One person has to be the data inputter. Another person has to be the reviewer. Another person has to be the authorizer. Don't let one person do everything. Please check internal control weaknesses. It's also a scheme that they use. And I've shown you how to detect it. And by reviewing the internal controls and advising them to do what we call segregation of duties. Then you come in and see another scheme. This is where accounts receivable. This is an area people use it a lot. Account receivables. What is an account receivables? You sold something to a customer. You sold something to a customer on credit. So if it's on credit, then you have to receive it. You have to. Then you have to go and chase for the customer to get the money. So your money that is in waiting for you to recollect because you're giving it to them on credit. So that is account receivables. When there's high levels of account receivables, and when you realize that the receivables is impossible to collect, then it's a signal that something is wrong. Sometimes you even go and follow up those who are owing. They don't exist, but they've recorded it as revenue that they have received this month, but they've not received anything. So accounts receivables so huge. Accounts receivables appears on the balance sheet. So what? Current assets, because it's something that is looking that you can change it to cash. So check the account receivables. Please pick it, do aging analysis, do independent confirmations, and then ascertain the truthfulness of the people who are owing. Then you can be able to know that something fishy is happening on the space. Then the last but one is unusual revenue growth. If you are there, last year companies are struggling, this year companies are struggling, but your company is reporting revenue of 10 times revenue. They are reporting 10 times revenue, but the industry-wise, they are not doing well. Compared to their peers, they are not doing well, but their company alone is recording revenue 10,000 times. Where are they getting that revenue from? Are they living in mass, or they are in a different world, or they are doing certain things that we don't know? Please consider benchmarking the organization against another company and ascertain where the unusual growth in the revenue is coming. Then you can be able to detect that something untoward is happening. Something bad is happening. Lack of supporting documentation. So normally you are going to review and they say they recorded these sales. The sales, they're saying sales is 10,000. Please show me the evidence that yes, indeed, payment has been made. There's no supporting documentation. There's no supporting documentation. That is the problem. Lack of supporting documentation is a scheme. Go show me the sales that have occurred. You don't know. If they have bought 10,000, they have paid 10,000. Where did they deposit the money? Where is the receipt that you give to the customer? They can't tell you. No supporting documentation. Then there is a problem. Unusual or complex transactions. So please, in detecting this one, you need to regularly review for supporting documentations for revenues and capture and assess the transactions complexity. Please review the supporting documentation, review the revenue that they've quoted in their worksheet or in their database. Then you can be able to detect that something wrong is happening. If you go and there's no supporting documentation for a sale that has been made $10,000, please, it's a red flag. It's a detection that you have to detect. And you have detected it because it is a fictitious revenue that was recorded. It is not real. So in conclusion, detecting fictitious revenue schemes is crucial for maintaining the integrity of financial reporting and protecting a company's financial health, reputation, and legal compliance. It is essential for we, the investors and regulators, to have accurate and reliable financial information to make informed decisions. Please, in detecting fictitious revenue, it is crucial because it boils down to integrity of our financial reporting. It boils down to protecting our company from any financial health or reputational risk so that investors may not be misinformed. And the tip that I'm leaving with you is that, please, you should be skeptical about large revenue transactions that are recorded near the end of the period. So getting to the near in some organizations, they give bonus and they give these commissions around March, April. So realize that December, revenue has increased astronomically. Boom. Please be skeptical, professional skepticism. Ask yourself, where is that revenue coming from? Immediately you see it, then you have to start questioning, being skeptical, picking it line by line and digging it. If you sold to Kojo, if you sold to Ama, if you sold to Adwa, please, I need to see a report, I need to see a receipt, I need to see this, I need to see that, just to juxtapose what is happening. So let us be very careful with transactions, revenue transactions that have been recorded at the end of the period, just to inflate our fictitious revenue. Thank you so much. for your time and everything. It's time for questions, suggestions, contributions, and deliberations. Thank you.
Wow, wow. Thank you. That is massive. I like the one-man commando aspect of things, the SOD. Yes, most of the times that is what we see, especially most of our people that are in the SME sector, the small enterprises. If it's one of the difficult sector to audit or to run an account for. Now the 4 lines, you see me, forgive me. You can open your mic if you have any question, suggestions, it's open. I'll also like to send the slides to participants. So kindly leave your name, email, and phone number in the comment section so that we can pick that up and forward the slides to you. Now you can ask any question. All questions are welcome. If you're having difficulties with your mic, you can use the comment section. The facilitator is available reading so that we can pick it from there and answer them. Thank you so much. So the floor is open. The floor is open. Any question? Any suggestions?
Someone has raised his hand, so you need to allow him to.
Yes, Isaac Asamoah. Yes.
Okay. Good evening.
Good evening.
Good evening.
I think it's a wonderful presentation, and then I'm really impressed. I wanted to request for the presentation slide because it was going faster, but I've sent my email address and contact. I'm happy about the presentation, so I'll be waiting for the slides.
You surely have it.
Okay, thank you, sir.
You're welcome. Any other person? No. Suggestion? Welcome. Comment.
Hello.
Yes, we can hear you.
Please, now my main question is, assume in my organization, I'm a professional accountant. And then, you are not the only person in management. There are other people. But you look at the pressure coming from other departments, maybe from especially sales and marketing, and maybe production, because of what the board has said. And so there's pressure on you. You yourself, you can see that what they are doing is contrary to the IFRS standard. How do you advise them or contain the pressure that, colleague managers, what we are doing, this is the consequence or this is the effect? Because normally accountants, we face these kind of challenges when it comes to issues of compliance. Thank you.
Thank you.
Great, thank you. Ms. Ma, can I
Yes,
answer?
yes, you can take that.
Okay. That is great. I think I'm a chartered accountant myself, and I've faced those kind of pressures in the past before. And I always say that, yes, sometimes it becomes a bit tricky and dicey because you are an employee and your employer is asking you to do something that you think is not in compliance with the standards that guides your professional work. But I always say that that directive that is coming from management, ask yourself, is it binded by a policy that has been approved by the board? Or the pressure, is it coming directly from the board to change the financial figures? If it's coming directly from the board that you should change the financial figures, I think that is where as an accountant, you need to write what I've done some before. You need to write a paper, a very succinct paper, concise, stating the policy. That's why I start from the policy. This is what the policy states. This is what the practice says. this is what professionally or per the standards that you have complied with. That is it IFRS or is it the GAP or is it the UK one that you want to use or is it the Ghana one that you want to use? You quote it within that one pager. Then you explain the risk that is involved. Then you explain the impact when it crystallizes. Then you come out and state your thoughts. So after writing this concise paper, please forward it to management. Put the executive in copy and then put the board in copy. Also, save that document in a secured place for yourself. Because of future issues that may come, you can rely on it that you gave them a professional advice, but they didn't take it, but they did what you call management override, which is a serious risk within the space. Management override. And in that case, some people will say it is against my tenets as a professional accountant. So I'm resigning. I can't stay in this fraudulent space. But you and I know that if you resign today, you will not get a job. And getting a job becomes a bit tricky. So always try as much as possible to let somebody shoulder that responsibility. So as an accountant, I'm sure you have a boss. Let your boss take it out from there. Let them change it for your boss to own that process so that you can be able to be behind it and then know that it has been handled by somebody who is superior to you, so you don't have anything to do with it. But before that, you have to make that succinct paper or concise paper to cover whatever you want to cover because of future issues. Because you can't resign, but let somebody own that changes that is happening within that space. If it's MD, let him own it. MD, I can't do it, please. Let them do it from here. This is what I've done. Take it and then let them do it from there. Let them change it and then they'll send it. Then you then take yourself out, but you don't become part of it. It's difficult, but I think it gets to a time you need to stand, you need to be principled to be able to get the right thing done so that in the future, your profession will not be affected in any way at all. I hope with my personal experience that I've shared with you, I'm sure it will go a long way to help you to be able to manage this situation because it is everywhere. It is everywhere. Thank you.
Yes, I would like to add something similar to that. So I agree perfectly with the facilitator when it comes to writing down, especially those of us that are working for, we consult for, let's say, the SMEs, these entrepreneurs and sole proprietors. Sometimes you prepare documentation and you give them that, okay, this is how it's supposed to go. They say, oh, change the figure and do it this or that and that. Kindly write it down and let them confirm. And if you think it's not in line with your professional ethics, let them know because of this, that I can't. That is what makes you more professional. But like we said, we all know that getting job lately is difficult. You can't say that because of that you are leaving your job. So you make sure that you send them, if it's a mail or something, you let them know that this is the right thing to do. If you say you wanted it this way, kindly confirm to me how you want it so that they write to you. Don't take verbal. Don't take verbal. For tomorrow, something happens, you'll be held responsible. I think so. I think my brother Joe Wahin is on the. Let me let you in.
Hello.
Yes, we can hear you.
Yeah, hello.
Yeah. Brother, thank you for your good presentation and good evening to everybody. Yeah, looking at the presentation, now the picture has been maybe the organization is maybe because of some enticement, they are giving unrealistic figures as far as revenue is concerned. Looking at the other side also, in an environment when the controls are weak, I believe revenue may be generated all right, and the credit figure will be recognized, but untruthful accountants may be getting the money back, but will not be reporting them. So all the time, debtors may be paying the money back, but realize the accountant can use his own means to get these monies into his own accounts or whatever. So I believe that we can also, as investigators, look at that session. And so also, I believe that whenever we are also going to investigate the fictitious revenue, we can realize a lot of these sales may be done. There will be no documentation like you earlier said. So it is up to us to be more concerned about underlying records when it comes to revenue. And some of this revenue we can also use the cash flow statement to match this revenue to see how much cash did the organization generate out of the whole revenue, so that we'll have fair ideas to the total amount of debtors that we are going to investigate. I hope if you do all these things, it will help us to come out with the wrongdoing, and for that matter, report these people. So in this case, debtors ledger is a document that will be more important to us. Zoom in to the underlying records that the initiating or the contract that generated all those revenue. If you do this, it will give us clear picture as to whether the person has defrauded the organization or done something wrong. Thank you very much.
Thank you, Joe. Thank you for the inputs, and thank you so much. Yes, we all know that when it comes to revenue, the first is it's either cash or credit. So, like you said, these are areas that we cannot let go like that as investigators. I call this platform fraudologists. I know everybody here is so in medical sessions, they have their own name, but I call them fraudologists from different fields. So if you need assistance of anything, you need any relevant question or anything, any help, even after this session, you get in touch with me. We'll definitely hook you up with someone that can help you. You know that you need the services of your brother or your sister that within the cycle. Any other question? Because our time is almost up.
Yeah, I want to ask a question.
Please do.
Yeah, we are in the industry to fight fraud and corruption. So I'm asking, is this training meant for members alone, or going forward we can spread the message to those outside the profession so that whoever is willing can join our training?
Of course, this is an open Zoom session, training session, because this is where we are. And when they join, that is where they'll be able to receive a lot of insight, a lot of updates, and even get in touch with the professionals that are on the platform so that we learn from each other. There are other professionals out there that we need their services that are not here. So this is an opportunity for us to bring all these people together. So it's open to anyone, any day. Next month we have another session, but I'll say that after we are about to close. So thank you. It's open.
All right, thank you. Okay, it means that for branding's sake, in our next sessions, we should try to
invite any
this notice to other people, so that in a way our name will also be in the space for other people to know that we have these professionals in the system. I think we have to work on that as individuals and as a group.
Sure. Okay. If no further question or comment or suggestion, I would like to thank our facilitator, Mr. George, for taking us through this to understand the industry, to update ourselves, to look out at the things to look for in fighting fictitious financial crimes within our corporate body, our corporate world. Next month, we'll have another session. That notice will be passed through. Yes, and if you've not left your email, telephone number, and your name, kindly do so in the comment section. Or I know most of you receive my text messages. You can still call to receive further information if you need. I think time is fast spent. We've eaten into over an hour, but we always say that we'll try as possible to be within the 1 hour so that members will not feel that they will, Fridays like this, it's not easy for everyone. Everybody's trying to run home. So I thank you all for coming. My name again is Besmark Allegra. I am the country director for CFIP Ghana, that is International Institute of Certified Forensic Investigation Professionals. Our field or body of knowledge has to do with investigation and forensic investigation, and that comes in different fields. So you see, I have my colleagues here, people that are lawyers. I have people that are digital forensic, that has to do with computer and technology. I have fraud examiners that are here. These are people that constitute the body. So it's made up of all these teams. So if you have any, you are setting up a team or you are setting up anything to go into investigate, can you get in touch? We'll hook you up with somebody that can join your team and give you and help you to run any investigation or any fraud activity or internal audit activity that you want to conduct. So I'd like to thank you all. I don't know, facilitator, if you have any further question or something to say before we leave, then I give you the floor.
Okay, thank you so much. I'll say thank you so much to everybody for your time and everything. And I'll urge you to continue learning and also continue networking and creating opportunities for each other. Let's keep on pushing each other upwards and upwards. It is when we are family at the top there and we are firm, then we can be able to push these things under within the space so that we can be able to grow together. Member success is all our success. So we have to always try to unite and then network and create more opportunities for each other. And I will entreat you to continue learning, because learning never ends. And aside the education that I do tuition too as well. So if I can suggest some certifications, if you want, CIMA is there. If you want to become a chartered management accountant, I can take you through for the case studies. The CISA and our IT audits is a space that we need a lot of people in there, which ISACA runs. I can take you through also as well. Certified Fraud Examiner too is there, and other professions that you are interested. If anything, you can also consult me, and I'll be able to provide my expertise so that we can all grow together. And thank you so much, Country Manager Bismarck, for the opportunity. And I say, may God bless you and keep you strong for your good work. Thank you, until we meet another time.
Thank you, Mr. Facilitator. I also like to thank I've seen a lot of my senior people here. If I want to thank, I'll call everybody by name, but I thank you all. I see Mr. Penton is one of the first people I used to consult when I started this thing, far, so many years ago. Thank you so much. James, my former director, country director, is also here. I thank all of you for passing through. I'll personally get in touch with all of you. And those of you that left your emails and contact, I will surely send you the slides. But if you need any further questions concerning CFIP and the certifications that we run and other things that we run as well, kindly get in touch and we'll definitely sort you out. Thank you for passing through. Thank you so much. Bye-bye and good evening. Have a lovely weekend. Thank you.
Thank you. All the best.
Thank you, James. I think James. Mr. George, I'll get in touch later.
Okay.
Yeah, I can see Abigail Amoa, Kennedy, Solomon.
Yeah,
Thomas.
please, I wanted the contact of our facilitator for consultation purposes, if that is possible.
It is. Check the comment section, and since he left his name is George, so you can see his name in the comment section. Or you get
Okay.
in touch, I'll definitely send it to you.
Okay, all right. Thank you very much.
You're most welcome, Abigail. I've seen some of my students. Yeah. Oh wow, great. Nice pursuit too. We have further sessions from next month. Every month we have a session, so definitely get in touch with all of you. Someone just joined. Who is that? Gabriel. Gabriel, you are late. Gabriel Kwabla, you are late. We just ended the session. So maybe you join the next one. I think the next session next month is something in the area of procurement fraud investigation. So we'll surely send you messages and updates on that. Thank you.